Hitting new highs almost daily, maybe harder to find those sleeper picks that can juice your returns. To that end, our next guest is highlighting three very different companies: a home builder, a mall operator, and a drugstore chain. Joining us for more is Tony Scherrer, Director of Research and Portfolio Manager at Smead Capital Management. Tony, great to have you. Let's talk about Walgreens first, since it's in the news in terms of private equity potentially wanting to take it private. You don't think that could happen, though? You like this stock for other reasons.
Well, yeah, if it happens, maybe that'd be nice, kind of sugar on top scenario, but that's not part of our investment thesis. We've owned it for quite a long time. At this point, I might say, kind of unfortunately, the last few years it hasn't worked well. But look, it's a Ben Graham type multiple. It's 9.5 times forward price to earnings ratio. It's just incredibly cheap. Even with all the headwinds they've been facing, with generic drug deflation that they've been facing. They lowered prices on the entirety of the front end of their store at the beginning of this year. These things are going to anniversary themselves, here pretty soon in the next couple quarters. But even as they've been fighting that stuff, they've had $5 billion in free cash flow. They own a valuable asset, about $5 billion worth of AmerisourceBergen. So it's a good business. It's a high quality business. It's been left for dead because of a lot of various reasons, but we consider it very cheap and very attractive for a high quality company right now.
Intellectually, Tony, I understand the notion of anniversarying those problems. At the same time, some of these issues, the scrutiny that PBMs are facing, which is part of their business, the competition on the front end of the store from the likes of an Amazon or a Walmart or all these online digital players, that's ongoing. These are things that are just ongoing issues. How do you discount that into the stock, which, by the way, is down 13% for the year?
Well, I think the market's done a pretty good job of discounting that into the stock. Stefano Pessina, the biggest owner of the company, owns 16% of the company, CEO, chairman. He's not happy with the public markets right now. That's why this conversation is going on. We'll see where it goes. It might be very difficult. It seems like everyone across the street is handicapping this probability to be maybe not quite zero, but very unlikely. It'd be the largest leverage buyout that's ever happened if it did happen. So again, we'll see how that goes. But in the meantime, you're getting a 3.1% dividend yield. I mean, the hatred and the distrust of this stock, in our opinion, is pretty well discounted in when you're trading at less than 10 times forward earnings in a market where the forward on the S&P is 18.5 right now or thereabouts. We think that's a pretty good margin of safety right here.
All right, let's talk Macerich, a mall REIT. Malls broadly are not doing well, but this is a very high-end mall REIT. So you think it's immune?
Another contrarian idea. We're value investors. We gravitate towards the things that are contentious. That's where you get the best prices. And as you say, I mean, anything in retail and certainly malls has been greatly discounted. Macerich trades at 11% dividend yield. That's a little higher than the 10-year Treasury yield for those that are doing the math on it. No, look, they own some of the highest quality malls out there. They have 52 products. They're A+, A++ type malls. And look, that hasn't been the place to have been. I mean, you've been hurt by being a mall REIT just by the fact that you are. That's why you're trading at that kind of a yield. But they're important. They're at 95% occupancy. They've been able to raise their rents from $40-some-odd per square foot about a decade ago to $61 right now. Their average sales per square foot on their average tenant right now is $800+ per square foot, one of the highest in mall REIT land. Their net operating income, they've grown about 4.2% per year over the last 4. Almost double that of GDP and about 3 times that of the average mall peer out there.
Right.
So they're very good operators, and we think it warrants some attention.
You got to be a long-term believer, though, in these stocks, because even though you said an 11% dividend yield, I mean, if the stock's down 35% year to date, your time horizon has got to be a lot more in order for that to be worth it. For both Macerich as well as WBA.
Correct, yes. Macerich is a new name for us. I mean, it hit the valuation screen along with several other quality screens that we look for. But from here forward, we think it's got a great margin of safety here.